Hello, everyone. Welcome to a Wall Street for Main Street podcast special. My name is Mo Daoud, and today's special guest is Chris Marchese. He is the mining analyst for the Morgan Report. Hey, Chris, thank you for coming back on.
Great. It's good to be here.
Well, we're glad to have you back. I want to start off by talking about what's going on in the general market. As you know, the Dow Jones made all-time high nominally. The S&P 500 and all the other markets are trending upwards thanks to the Federal Reserve endless money printing. So I wanted to get your opinion on what you think is going to happen to the stock market going forward. Do you think a crash is coming soon? I see a lot of people predicting a 1987 type crash. What's your opinion?
I really don't think it's going to be that type of crash just because, as many know, the Fed is continually pumping liquidity into the financial system, and financial problems are what typically lead to stock market crashes, generally speaking. So I just think that there's too much liquidity in the system for anything major to happen. There might be one abroad in, say, Europe, but in the U.S., I think, we're going to sit around these record levels and maybe trend down, trend up a little bit, but nothing big. I don't see a 1,000-point retracement in the Dow or anything like that over a short period at least. So, it's interesting times.
Yeah, I don't think we're going to see another, 2008 type crash where, the market went down 500, 1,000 points in a short period of time, mainly because of what the Federal Reserve is doing. If we had a free market, the market would crash today.
Yeah.
But we don't. We have a managed market, so people forget about that. And you see a lot of technicians out there, reading the chart, they see a crash coming because it's completely overbought. I agree, but you have to remember that the Federal Reserve has a big role in why the stock market's going up.
Yeah, and people are is worried about everything. Say the unemployment picture, which, although they say it's declining, that's because the workforce has shrunk. But if you have a higher stock market, people tend to feel richer, even though it's a false sense of prosperity. So a lot of it's psychological.
Yeah, if you factor in inflation to the stock market, there's really, if you look at the real return instead of the nominal return in the stock market, there's not much return going on. I mean, 2007, when we hit all-time high in the stock market before it crashed, if you look at the gas price back then, and the food prices as well. I mean, it wasn't as low as it was back then compared to today, where it's higher now. So people forget about that, and they think they're making good money in the stock market, but if you count inflation, they're not.
Yeah, exactly.
Okay, great. I want to transition here and talk about what's going on in the gold and silver market, and as many people know, it's getting clobbered so far in 2013, especially the gold and silver stocks. In your opinion, what is going on in the gold and silver market? Why has it been taking a big beating?
I wish I knew the answer, but the metal prices are relatively high. Cash costs have started to relent a little bit, so there is no real there's no fundamental reason why the mining equities should be at these extreme levels. I mean, it's the gold to Huey ratio is more than 3 standard deviations above the mean, which is just unheard of. I mean, right now, or as of last Friday, the gold to Huey was 4.62, and at the peak in 2008, it was only 4.75. So we're seeing a 2008 type event, although it's not as noticeable because this has been protracted, whereas 2008 happened in just a few months. In the last 10 years, there's only been 47 trading days where the gold to Huey ratio is traded above 4, and 37 of those days have been in 2013. So it gives you a little perspective on how extreme this current situation is. But, you know, like Warren Buffett said, although I'm not a big fan of his, you know, you want to buy when there's blood in the streets, and there's certainly blood in the streets right now.
Yeah, there's definitely a lot of blood on the street. Now, when you compare what's going on right now in terms of the gold and silver market and how undervalued it is compared to 2008, is it more undervalued today compared to 2008, or is it pretty much almost the same? Because I know you track that.
Yeah, I would say that it's more undervalued because margins have expanded, even though cash costs have been rising rather precipitously.
Okay. So I want to get your outlook for the next few months on what you think is going to happen in gold and silver market. Is there any reason for investors to hope that it's going to go up anytime soon? Because I predicted that the second quarter of 2013 we'll see a jump in gold and silver, not in 2001. What do you think?
Yeah, that's hard to forecast as well. I think we've bottomed, or there's a bottoming process going on at this point. In terms of the next leg up for the metals, it could go as far out as a year. I mean, we might be stagnant for a year. Although, I don't think that's the case, but I can't rule it out. What we need is fresh buyers, not the same buyers that have been in the market for years. So hopefully with, say, Japan wanting to ease quite a bit, that'll bring a new class of buyers into the market, or a China ETF will take a lot of supply off the market, or something to that effect. Maybe even something like Sprott Physical Trust buying. Maybe they'll put another few $100 million, because I know the physical markets they're tight, but they're not tight to the point where they're ready to move up significantly. I mean, as of Friday, there was backwardation in the market, which leads to higher prices, because that means that there's a shortage. But, it's not, it wasn't that extreme. So, I mean, it could go into backwardation quite to a much higher degree before the next leg up occurs.
Just for people out there that don't know what backwardation means, could you explain that to them?
Yeah, that's when the spot price is above the futures contract price. So there's basically a negative price discount on the silver, meaning people want their silver now as opposed to waiting a month or two, and they're willing to pay up for that. So that's what the backwardation is saying. Again, it's only around 10 cents, so it's not material at this point, but it is showing that something big could be in the works.
Right, and the last time we had backwardation is back in 2011, right before silver took off and went up all the way to $48. Is that correct?
Yeah, and I wrote an article, I think, that February on Seeking Alpha, talking about that and how it was ready to take off, and it ended up doing so. But unfortunately, it went up to the $48 level and got smashed down.
Well, we're gonna have to keep a close eye on that, and hopefully next time you come, we'll go back and look at that. I want to talk about the gold and silver market, which also has been clobbered as well. And because it's more volatile and more leveraged, every time gold and silver goes down, the mining stock goes down even more, percentage-wise.
Exactly, and on the way up, they always lag. So
kind of tells you that the hot money or the big players are not fully into the precious metals market. Is that correct?
Oh yeah, definitely. There's a long way to go.
What are they going to take for the big player to come off the sideline and join the party? It's going to have to take some kind of crisis where, the currency hyperinflate, or there has to be some type of black swan event for the hedge fund managers and money managers to join the party?
I think it'll. Unfortunately, investors tend to buy when something has already outperformed, so they buy high. So I think what I think will happen is foreign investors will drive the price higher, and that will cause institutions and the like in the U.S. to start, buying some of it. But at that point, I think the metal prices would be significantly higher, because the buying frenzy should occur at these levels or when it's low. But investors aren't logical a lot of times, and they'll start buying when it's high. Just like, I bet in a few years when the prices are much higher, silver in the triple digits, gold well over 2,000, that's when central banks will really start to buy. And as many remember, they sold when it was almost at the absolute lows.
Yeah, I agree. I think once like gold hit 2,000 and silver goes above 50, I think you see a lot of investors jumping in, because that'll be an all-time high for silver once it goes past 50. And I think a lot of people will start thinking, hey, maybe there is a bull market in this silver market, and since it, got into all-time high, and they'll join the party and take the prices even higher.
Yeah, exactly.
Okay, great. Now, and if you look at all the junior mining stock that's out there, and I don't know if you read John Kaiser's report on thegoldreport.com, but he is predicting that about 500 of the junior mining stocks on the TSX will either go bankrupt or sell their assets for pennies.
I agree. Yeah.
Do you agree?
Yeah.
Why is that?
The balance sheets just don't look good. They can't raise money. The equity markets are weak in that sector. So going to the market, unless you're a high quality company, you're not going to get a full subscription to your financing. And, there's a lot of, since we've seen, gold hit record high after record high, and silver up significantly, it's the best performing commodity since 2000. A lot of public companies went public that really had no good assets, but they were able to raise money because the metals were doing so well. So these will get wiped out, which is a good thing.
Yeah, I agree that consolidation in this industry it's very much needed, and it'll be very healthy in the long run for the gold and silver stocks. And why do you think that these companies will go bust? Is it a reflection of bad management, or just the difficulty of getting financing from banks or other institutions, etc.? What's your opinion?
I think it's the financing issue. You continually need capital to explore and drill out your property. But that's, for the lower quality companies, which unfortunately there are quite a few of. And, you can only raise money so many times before a bank will realize that, there's nothing there, which, in a lot of cases, that's the truth. And even for high quality companies, it's relatively hard to get financing, or the terms aren't that attractive.
Right, and a lot of banks out there are very afraid to lend money to the mining industry, and I can see why, because if I don't know if you listened to Nolan Watson's video presentation he did, but over 70% of mining companies, when they set a production target, 70% of them don't meet it on time or because of delays, which is pretty normal in the first year of production. And also when they set out production guidance, they don't hit them either. And this just tells you how difficult it is to get these mines online without any delays. It's a very complex industry.
Yeah, and the margins aren't what they're usually forecast to be. The CapEx, you see a lot of overruns in that. And, yeah, everything's over budget. So, at some point the gold price and silver price will start to accelerate a lot faster than the rise in input costs, but we're not there yet.
And that's the next thing I wanted to talk to you about. You talk to a lot of CEOs, near producer CEOs like Holdress, Sandstorm, etc. What is the number one concern they have when for their mining project that they have? Is it rising input costs or trying to keep capital expenditure under control? So what have they been telling you?
Oh, for the streaming companies, the royalty companies, it's trying to find projects that will be that are in the lowest quartile of the cost curve, which is very important for those companies because they buy a part of future production, so they have to be able to weather all parts of the economic cycle. When prices are high, when prices are low. So they care about that. With companies like a Holdra or an Endeavor, it's keeping costs under control, taking measures to optimize the efficiency of their operations. And a lot of them are looking towards growth. What are they going to do for growth? With the rising capital expenditures, it's hard for them to free up enough capital to acquire assets that would be ideally suited for them.
Now, I want to talk about your top pick for 2013. So, before we started this podcast, I believe you agreed to give our audience some of your insight on your favorite gold and silver stocks. What is your number one top pick for 2013 and why?
I don't really have a top pick. I kind of have a basket of picks, and they go as follows. They're not in any specific order, but Alexco would be one of them. They are just waiting a permit to bring 2 mines online, which are ready to go. That'll increase production approximately 40% this year, as well as bring cash costs down. And, they're a Canadian operator, which is rare with silver companies. So that's one of them. Plus the price has been beaten down like all the others. Holdra is one. They have a high-grade operation in Canada. They're going to declare commercial production this month. And they just raised $10 million, so they got more than enough capital in case prices go down or whatnot. And they have I think like a $40 million market cap at this point. And at capacity, they'll be able to produce approximately 2 million ounces a year at about around $5 an ounce cash costs. And this mill can be expanded about 3 times as big to 600 tons per day. So, they have organic growth lined up. So I think this will be a good performer going forward. And another one is Colossus Minerals. They have one of the highest grade deposits in the world. They're in Pará State, Brazil. Incredible management team. They worked at the Yamanas, the Agnicos, the Barricks of the world, and they're going to commence production in the second half of this year. There's a lot of uncertainty in it because they haven't drilled out a resource estimate yet, although that's due this year. So it's being punished because of that. The market always punishes companies that skip their 43-101 and construct their mine first. And the last one is a zinc silver company called Trevali, and it operates in Canada, and it's about to start production in Peru. We're really bullish on zinc prices starting towards the end of this year through the next 5 years, just because there's so many of the world's largest mine, for example, the Century Mine in Australia, the Perseverance Mine, and a host of others that are nearing depletion and will become depleted over the next 1 to 2 years. And not that we're bullish on base metals, far from actually, but if you short one metal, like I would short lead and go long zinc, and we expect that to be a good trade, a longer term trade. And the way to play it, we think, is in the equity market is with Trevali. Plus, they have a good amount of silver as well. And that's about it. And of course, we love the streaming company. Silver Wheaton just inked a $1.9 billion deal with Valet, and that'll show up to the bottom line immediately. So they're doing a great job.
And all these companies you just mentioned all have good growth profile going into the future, good management.
Yep.
And all these companies are showing that they're going to be able to keep the cash costs in control and try to keep it as low as possible. And the grades are pretty good as well, which is, I think, one of your biggest factor when you look at gold and silver companies, what kind of grades they have.
Yeah, exactly. And Alexco and I should say Holdra have some of the best grades out there. And Colossus, as I mentioned, is one of the highest grade, if not the highest grade, mine on record. They can't officially state that because they don't have a resource estimate at the moment, but they should be able to soon. Plus, I didn't mention before, but their byproducts are platinum and palladium as opposed to base metals. So net of platinum and palladium, their cash cost should be between minus $100 an ounce and $200 an ounce. So it's definitely economical.
And do you ever see a situation where you invest in a company that has lower grades than companies like Holdra or Alexco? And why is the grade important when you invest? What's the big deal about the grade?
The grade is it leads to lower cash costs. Typically, unless say you have a high strip ratio, there's a lot of waste, or the haulage cost is quite a bit. But typically, higher grades lead to lower costs. And in a rising input environment, you want to keep an eye on that. And again, you can produce more with a smaller mill when you have higher grades, which is more cost efficient on the capital side. So that's the basic reason that we prefer higher grades, and because lower grades, they're more sensitive to rising input costs, so the margins will get squeezed more than a high grade mine will. Again, this is generally speaking, and there are exceptions.
And what exceptions are there that you would invest in a company with low grade? Is there any reason?
Say it's an open pit and there's a low strip ratio. We would like that, or say like Colossus, there's a good byproduct. If you have platinum and palladium as a byproduct, it'll net out the co-product cash costs. Also, if there's say there's a deposit that's rich in zinc, and we think zinc prices will do well, matters the grade of the byproduct as well. And if there's even though gold and silver mines are rare, or not as common as base metal mines with precious metal credits in them, you don't need as high a grade from gold and silver because you have more total ore of precious metals. So say you have a gold and silver mine that are 1.5 grams per ton and 100 grams per ton silver. That's much better than, say, just a deposit with 100 grams per ton silver, or a deposit with just 1.5 grams per ton gold and no silver.
And excellent, and I agree with what you just said there. I think there's a good case to invest in, companies with lower grade, but the factor that you just mentioned has to be considered when you do that. And I prefer companies with higher grade because it means lower input costs in most cases if they execute it the right way. So I want to final topic here to talk about the new report that you just created. Resources and Riches, is that correct?
It's richesandresources.com, and basically it's me and some other analysts. We put together research reports on natural resource companies, not just precious metals, and we sell them for much cheaper than you would find elsewhere, or you can email us a company that you would like research done on, and we'll do it for you. We also have a top picks for 2013 report out, and we have some contributors such as Keith Schaefer that have put reports on the website, and that's kind of just a little project that we're doing. Because most of my time is spent working for the Morgan Report, and we're starting an investment fund called Lemuria Special Opportunities Fund, and should be launched sometime this month. We're raising money at the moment, and so we got a lot going.
And if people want to find out more about your fund and your report, where can they go?
Just send me an email, or if you want to find out about the reports, go to Riches, RICHESNIN resources.com. Or if you want information about anything else, just send me an email at chris@silver-investor.com, and I'm pretty good about my emails, so I'll get back to you in a relatively quick manner.
And great, and you're still contributing to the Morgan Report as well.
Yeah, that's my main job. So.
And great, and people can subscribe to the Morgan Report by going to silver-investors.com.
Yes.
Okay, Chris, well, thank you for coming on Wall Street for Main Street podcast. Hopefully you can come back on in another time.
Sure. My pleasure.